Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Nike.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, I want you to picture a giant, just a globally recognized titan of industry, right? A brand with a logo so ubiquitous that you probably see it like 3 times before you even finish your morning coffee.
Oh, easily, yeah.
For decades, it's been the undisputed heavyweight champion of its sector, but today that giant is basically lying on the mat. I mean, the stock has plummeted over 70% from its all-time high.
Which is just staggering to look at.
It really is. It is currently trading near multi-year lows, hovering right around $52.83 a share. The brand, obviously, is Nike.
And, a 70% drop for a blue-chip consumer staple like that, that's the kind of chart that makes institutional investors sweat. But importantly, it makes value investors start paying very, very close attention.
Exactly. And that is why we are unpacking this today. We're tailoring this entire discussion specifically for you, the listener, to help you cut through the absolute cacophony of extreme market noise out there.
Because there's a lot of noise right now.
Oh, an unbelievable amount. So we've got a massive stack of current financial reports, technical data, and market sentiment trackers from right now, April 2026. Our mission today is to figure out what is actually happening under the hood. Like, are we looking at a classic falling knife that you absolutely need to avoid, or is this a rare, washed-out valuation offering just a golden wealth-building opportunity?
Right. And the data we're pulling from covers a lot of ground today. We're looking at their fiscal Q3 2026 earnings report, plus this huge wave of recent Wall Street analyst actions. I mean, we're talking over 20 price target cuts just in the early part of April alone.
Wow, 20 cuts.
Yeah, it's brutal. And we're also going to break down the specific mechanics of the new CEO, Elliott Hill, and his really aggressive turnaround strategy.
Okay, I want to start with the mood in the market, because looking at this data, there is blood in the streets. You mentioned Goldman Sachs and 20 different Wall Street analysts cutting their price targets all at once in early April. When I see that, I immediately wonder, is the company fundamentally broken, or is Wall Street just panicking in unison? Like, how does an avalanche of downgrades like that actually happen simultaneously?
Well, it really happens because of how institutional models work. So when a company releases a tough earnings report, and crucially, when a new CEO steps in and lowers expectations for the future to give himself some breathing room, every single analyst on Wall Street has to update their mathematical model.
Right, they have to recrunch the numbers.
Exactly. They plug in lower expected sales, and the formula just automatically spits out a lower price target.
Yeah.
But the mechanism you really need to understand here is the feedback loop.
Okay, walk me through that.
When 20 analysts slash their targets simultaneously, it triggers algorithmic selling. Huge mutual funds and pension funds, they often have very strict mandates. If a stock's outlook drops below a certain quantitative threshold, they are literally forced to sell.
Oh, wow. So the selling pressure isn't necessarily just human beings waking up and deciding they hate the brand today. It's automated risk management kicking in, just forcing massive blocks of shares onto the open market.
You nailed it.
Yeah.
And that forced selling pushes the price down even further, which then, of course, makes the stock look even riskier on paper, which can trigger...
Even more selling.
Exactly, becomes this vicious, self-fulfilling cycle.
And we can actually see that cycle bottoming out in the technical data. When the stock fell through the floor, breaking key psychological support levels between $50 and $52 a share, it triggered this massive, highly unusual spike in trading volume.
Yeah, the volume spike is critical to look at.
Right. So what is going on there mechanically? Does a volume spike like that mean the worst is over, or is the floor just completely giving way?
Well, technical analysts look at that specific kind of massive volume spike, especially after a really long, brutal downtrend. And they often view it as maximum pain, or what they call a capitulatory bottom.
Break that down for me. What does capitulation actually look like behind the scenes for an investor?
Okay, so imagine an investor who bought in at $100. They watched it fall to 80, then 70, holding on the whole time, just hoping for a bounce. By the time it hits 52 and 20 analysts have just downgraded it, the emotional exhaustion peaks.
They just can't take it anymore.
Right. Or, more importantly, the financial leverage breaks. Say they bought on margin with borrowed money. Their broker basically forces them to sell at a massive loss just to cover the loan.
Ouch.
Yeah, it's painful. So the volume spikes because all the remaining weak hands, all the holdouts, are finally throwing in the towel. Technical analysts view this as the bottom because the selling pressure exhausts itself. Anyone who was going to panic sell or was forced to sell already has.
It makes me think of like a superstar athlete missing a few crucial shots in their own home stadium, and suddenly the home crowd turns on them and just starts booing relentlessly.
That's a great analogy.
Right, because to an outsider, it looks devastating. You think their career is just over. But I'm looking at these sentiment trackers, and there are actually sophisticated options traders stepping right into the arena right now. They are employing these low-risk, high-reward strategies to basically bet on a rebound.
Yeah, the contrarians are definitely circling.
Yeah. Even Jim Cramer has publicly targeted a 30% upside bounce, looking at a return to $70 a share. Why would contrarians bet on a massive bounce right when the crowd is booing the absolute loudest?
Because contrarians always look for mispricing. They look for that exact moment when the market's emotional reaction has pushed the price far below the actual mechanical value of the business.
Yep.
But to understand if they are right, to see if Cramer's $70 target is actually realistic for your portfolio, we have to look past the stock chart. We have to peek under the hood at the actual plumbing of the business model right now.
Let's absolutely lift the hood on that plumbing, because the headline numbers from that fiscal Q3 2026 report are just brutal. I mean, revenue declined 9% year over year, dropping down to $11.3 billion.
Yeah, it's a big hit.
And the actual earnings per share dropped a staggering 30%. Did people just stop buying sneakers, or is something else fundamentally shifting inside the company?
People are definitely still buying sneakers, but the company's radically changing how they sell them. What looks like this terrifying organic decay in those numbers is actually a deliberate, painful, kitchen sink kind of reset.
Driven by the new CEO, Elliott Hill.
Exactly. He's implementing what they are calling the sport offense strategy. And the absolute cornerstone of this strategy is intentionally de-weighting and dismantling their direct-to-consumer, or DTC, architecture.
Okay, I am so glad you brought this up, because I still don't totally get it. For the last decade, this brand, and basically every other major brand out there, spent billions of dollars telling investors that cutting out the middleman was the entire future of retail.
Oh, absolutely. It was the only thing they talked about.
Right. Keep all the profit margins, own all the customer data, sell directly through your own app and your own flagship stores. How are they now convincing Wall Street that going back to selling through third-party wholesalers isn't just a massive, embarrassing failure of that entire vision?
Well, it is an agonizing shift, for sure, but it's a necessary one. Think of a marathon runner who suddenly realizes at mile 20 that their stride is actually tearing their meniscus.
Oh, man.
Yeah. Deciding to completely change your mechanics that late in the race is incredibly painful, and it will definitely slow you down in the short term. But if you don't change your stride, you literally won't finish the race at all.
But what was actually tearing the meniscus here? Like, why was the heavily hyped direct-to-consumer model hurting them so badly?
Two main reasons: inventory risk and shelf space. In a purely direct-to-consumer model, the company has to forecast demand absolutely perfectly. They pay the factory to make the shoes, put them on a boat, store them in a massive warehouse in Ohio, run incredibly expensive digital ads, and then just wait for you to click buy on the app.
And if the consumer doesn't click buy,
then those shoes just sit in the warehouse, trapping millions of dollars in cash. Eventually, they have to run these massive clearance sales just to get rid of them, which completely destroys their profit margins anyway.
Ah, okay. So by doing everything themselves, they essentially took on all the logistical risk that a massive retailer usually handles for them.
Exactly. When they sell wholesale, they just sell a massive pallet of shoes to Dick's Sporting Goods or Foot Locker. The retailer pays upfront. The retailer takes on the risk of storing them and eventually selling them to the public.
That makes a lot of sense.
But honestly, the even bigger issue was the real estate. When they pulled their premium products out of those physical retail stores to force people onto their app, they effectively abandoned prime real estate. A massive, beautiful wall of shoes inside a busy sporting goods store is essentially a free billboard.
And when they arrogantly took their shoes off that billboard, other brands just moved right in.
Yep. Hungry, aggressive competitors like On Running and Hoka eagerly took up that premium shelf space. They essentially handed their rivals free advertising and customer exposure on a silver platter. So this massive strategy shift by Elliott Hill is really all about reclaiming that physical shelves. It leverages their massive, unparalleled distribution scale to re-engage those essential retail partners before they lose them forever.
Okay, that makes perfect sense of the mechanics. And looking closely at this Q3 data, it seems like the algorithms and the contrarians are actually sniffing out some green shoots related to that exact pivot.
Yes, there are definitely some hidden positives in the gloom.
Right, because despite the 30% drop in overall earnings per share, they actually still beat Wall Street's bottom line expectations by posting 54 cents per share. And they did that through some pretty aggressive cost management, slashing marketing, and corporate overhead. But more importantly, the specific revenue from wholesale actually grew by 5% year over year.
And for investors building a thesis, that 5% growth is the first real proof of concept for the turnaround. It tells us that these retail partners haven't slammed the door. They're willing to welcome the brand back onto the shelves.
Which is huge.
It is. Furthermore, North America, which is their absolute core, foundational market, officially returned to positive growth for the first time in 8 quarters.
Wait, 8 quarters, so 2 full years of contraction, and they finally flipped the home market positive? But here is my concern for the listener who is maybe looking at their portfolio and thinking about jumping in at $52 a share. How does a company survive a structural transition this massive? I mean, they are literally tearing down the sales model they spent a decade building, and they're begging retailers to take them back. Doesn't a business usually just hemorrhage cash during a teardown like that?
Usually, yes, they absolutely do. But they survive this because of massive structural defenses, what Warren Buffett or economists would call an economic moat.
Right.
Their balance sheet is currently acting as a giant shock absorber. The analysts point specifically to their massive cash hoard and their incredibly strong free cash flow.
Yeah.
Even in a transitional, painful fiscal year where top-line revenue is shrinking, they are still generating immense amounts of cash from their global operations.
Which leads right into a huge factor for the income investors listening, the dividend.
Oh, yeah. The dividend is key here.
This company has maintained 24 consecutive years of dividend increases. Right now, they are paying 41 cents per share every single quarter. And because the stock price has fallen so drastically, that pushes the annual dividend yield over 3%. That is a very rare yield for a historically growth-oriented consumer brand.
It really is. A 3% yield on a fortress stock of this caliber offers a very compelling incentive. For an income investor, it essentially pays you to wait patiently while the operational turnaround takes hold over the next 12 to 24 months.
But let's play devil's advocate and be realistic here. Earnings dropped 30%. They are in the middle of a notoriously painful restructuring. Is that dividend actually safe? Or is this a classic yield trap? Because we see companies cut their dividends to save cash during hard times all the time.
That is the critical debate among analysts right now. Currently, the math says the dividend is still safely covered by their free cash flow. But there are some really interesting speculative rumors in these reports about how far management might go to protect it if the turnaround suddenly stalls.
Oh, really? Like what?
Yeah. You're seeing chatter about potential product line cleanups or even entirely divesting non-core brands. There are rumors about potentially selling off Converse, for example, to streamline the portfolio, raise a huge chunk of capital, and absolutely bulletproof that dividend payout.
Wait, why are they so fiercely protective of it? I mean, why even consider selling off an iconic brand like Converse just to maintain a quarterly payout to shareholders?
Because of the calendar and the deeply mechanical way modern stock markets work. They are currently sitting at 24 consecutive years of dividend increases. If they manage to raise it just one more time in September 2026, they officially achieve dividend aristocrat status.
Oh, wow. And what actually happens mechanically when they hit 25 years?
It triggers a massive wave of mandatory automated buying.
Really?
Yeah. There are massive institutional income funds, ETFs, and algorithmic trading programs whose entire legal mandate is to buy dividend aristocrats. They don't look at the sneakers. They don't care about the wholesale pivot. They just look at the 25-year streak.
So it's basically automatic cash flowing into the stock.
Precisely. Hitting that milestone unlocks billions of dollars of institutional buying pressure. Management is acutely aware of this mechanism, and they will likely do whatever it takes to cross that 25-year finish line in September.
That is a phenomenal hidden mechanism to be aware of. So the balance sheet is a fortress, and the 25-year dividend mark is this massive carrot dangling in front of investors. But there's another layer to this defense that isn't really on a spreadsheet, right? It's the consumer psychology.
Definitely. The ultimate moat here is their brand equity. In economics, we talk about switching costs. The friction a consumer experiences when moving from one brand to another.
Like the hassle of breaking a cell phone contract, right?
Exactly. Usually is a financial or logistical cost. But here, the switching cost is deeply cultural.
Because, I mean, even with rivals like On and Hoka making really serious incursions into the running shoe market, people aren't exactly wearing Hokas to play in a pickup basketball game.
No, they're not. The enduring cultural gravity of the Jordan brand and their absolute dominance in key sporting categories like basketball really prevent permanent market share loss.
Yeah, that makes sense.
A consumer might buy a highly specialized pair of running shoes from a competitor for their morning jog, sure. But they are still buying Jordans for everyday streetwear, and they're still buying Nike cleats for their kids' soccer season. That deep cultural cachet is incredibly difficult for rivals to permanently erode. And crucially, it buys management the time they need to fix the operational plumbing.
All right, so they have the cash hoard, they have the cultural weight, the wholesale strategy is finally showing a pulse, and the dividend algorithms are just waiting in the wings for September. But let's not paint a purely rosy picture here for the listener. What is actively bleeding right now? What could realistically derail this entire 12 to 24-month turnaround thesis?
The primary risk, and it's laid out very objectively in the financial reports, is severe gross margin compression.
Okay, how severe?
In the third quarter, gross margins dropped by 330 basis points. They are down to 41.5%. For a company doing $11 billion in a single quarter, losing 3.3% of your margin means hundreds of millions of dollars in profit is just simply evaporating.
That is a massive leak. Walk me through the mechanism there. Why are they suddenly making so much less profit on every single shoe they sell?
It's basically a toxic convergence of three painful factors. First, we go right back to that inventory glut from the direct-to-consumer model. Because they overproduced and miscalculated demand, their massive warehouses are full of old product. The only way to clear space is through heavy markdowns, which obviously destroys the profit per item.
Right. And the second factor?
The pivot to wholesale itself.
Yeah.
It inherently yields a lower profit margin per shoe than selling directly through your own app, because obviously you have to give the retail partner their cut of the sale.
Got it. And what's the third factor squeezing them?
Geopolitics. New U.S. tariffs on Asian imports act as a direct tax on their supply chain. And since they can't easily raise the retail price of their shoes right now, because consumers are already exhausted by inflation and the company has too much inventory anyway, they have to absorb the cost of that border tax themselves.
Squeezed from the sales side and squeezed from the supply chain side. And speaking of geopolitics, there is another glaring red flag in this data regarding their second biggest market globally. Revenue in Greater China didn't just slow down, it actually contracted by 15%.
That is a massive, massive headwind. Historically, they have relied on the rising Chinese middle class as a huge growth engine. If macroeconomic conditions in China continue to deteriorate, forcing consumers there to spend less, or if local Chinese competitors continue to aggressively capture domestic market share,
then that growth engine remains seriously impaired. So, if the Chinese consumer stays home, or if they have to keep slashing prices in the U.S. to clear out those Ohio warehouses, the turnaround completely stalls out. The margins stay compressed. But let me challenge that bear case from the perspective of our current $52 share price. Haven't these risks already been baked in? Like when a stock gets cut by 70%, hasn't the market already basically assumed the absolute worst case scenario for China and the tariffs?
that is the exact core of the value investor's thesis right now.
Okay.
The negative news regarding the tariffs, the China contraction, the painful margin drop is universally known by the market and arguably fully priced into that $52 valuation. Analysts looking at the risk-reward skew are noting that the downside seems very clearly defined at this point. Meanwhile, if Elliott Hill's wholesale turnaround actually gains sustained traction, the upside from $52 is extremely substantial.
So for the listener who is tracking this alongside us, managing their own wealth strategy, what are the specific milestones on the calendar they need to watch for to see if this turnaround is actually working?
You need to monitor the Catalyst calendar very closely. The late June 2026 earnings report, which will be their fiscal Q4, is the absolute next major hurdle.
What exactly are we looking for in that report?
Two specific data points. First, stabilization in that China revenue to prove the bleeding has finally stopped. And second, absolute proof that the 5% wholesale growth we saw this quarter is a sustainable, accelerating trend, and not just a one-off fluke.
And beyond the company's own earnings, we have to keep a close eye on macro policy, right? Any shift in U.S.-China trade relations or any easing of those import tariffs would instantly remove a massive cost burden and provide almost overnight relief to those compressed profit margins.
Absolutely.
And of course, we were watching closely for that September 2026 dividend declaration to see if they officially trigger the dividend aristocrat buying wave.
Right. The roadmap for the next 6 months is very, very clear. The smart money will be watching those specific data points to see if the engine is truly restarting.
So based on this massive stack of reports, the technical capitulation, and the strategy notes we've broken down today, the consensus thesis really points to a 7 out of 10 bullish score over a 12 to 24-month horizon.
I agree with that. It is a high conviction value play on a fallen giant. But, it is fundamentally tempered by execution risk. The strategy makes total sense on paper, but management still has to prove they can flawlessly execute the complex logistics of rebuilding their retail network without entirely losing their digital edge.
It is definitely a waiting game, but honestly, analyzing a situation like this is essentially a masterclass in corporate mechanics. It really teaches you how to separate a company experiencing painful operational growing pains like dismantling a flawed DTC channel from a company suffering a terminal business decline.
And it perfectly illustrates how patient investors look for wealth-building opportunities in market capitulation. When automated selling and just sheer emotional exhaustion push a massive, iconic brand to multi-year lows, it often leaves a highly mispriced asset on the table.
For anyone willing to look past the panic.
Exactly. For anyone willing to look past the panic of the next quarter and focus strictly on the mechanics of the next 2 years.
It all comes back to that image of the giant lying on the mat. The crowd is booing, the scoreboard looks terrible, but the underlying muscle memory, the massive cash flow, the 24-year dividend streak, the unparalleled cultural weight of the brand is still totally intact, just waiting for the right strategy to kick in. Which leaves us with a lingering thought to ponder long after today's analysis is over.
What's that?
When a brand reaches the truly ubiquitous global scale of Nike, when its logo is literally burned into our cultural consciousness, does that immense cultural weight inherently protect it from permanent financial failure? Or is every giant, no matter how monumental, ultimately at the mercy of shifting consumer tides?